If I was starting over as an investor in today's crazy stock market, there are only three things that I will buy, and I'm going to show you in this video. Welcome to Paradigm Shift. My name is Patrick Buffy. Here we teach you how to dramatically improve the quality of your life. But before we start, I would like you to share and subscribe, like and share and subscribe. Today's topic is going to be three ETFs that I would invest as a beginner. Three ETFs that I would invest as a beginner. You see, like I said, if I'm starting to invest in today's crazy market, I wouldn't try to find the next NVIDIA or the next AI stock. No, I wouldn't even do any stock trading or forex or option trading. In fact, I wouldn't even invest in individual stock at all. I wouldn't buy Amazon, Walmart, Apple. Yeah, I wouldn't buy NVIDIA. In fact, if I was brand new investor, I would only focus on three things. Hence the topic, three ETFs I would invest as a beginner. Now, what is ETFs? ETFs are exchange traded fund. Exchange traded fund. Yep, I will say it again. I wouldn't invest in Walmart or Apple, but rather I would invest in a fund. Yes, I will invest in a fund. A fund like what those individual companies that are very hot right now are already in, like Amazon, Apple, McDonald's, Tesla, and other hundreds of other companies. That is what I will invest in. But before we start, before we go on, let me share this with you. What you have to understand is when you're investing in when you're investing in an individual stock or a single stock, what you are doing is you have to be the manager. You have to make sure you know when to sell, when to buy more, and you have to also know how to read these companies, their balance sheet and all that. And I can guarantee you, not a lot of people know how to read the balance sheet. And even those that can do that don't have the patience to do that. But if you buy the share, the fund, that fund is being managed by a thing or an individual. You see, that's the difference. Yes, the individual stocks, the good thing about the individual stocks is it's very hard. Ooh, you get more profit. It goes up quick. So it's good. But you have to be able to manage it well. Because since you are the manager of that particular individual stock you've got, you have to be able to know if the company is going down or the company is coming up. And you have to read all these things to be able to, you have to be in tune with this company, follow up all the time. And it's hard. It's not easy. That's why you need the fund that somebody else is doing it for you. I understand somebody like, oh, there's no way, a company like Amazon is going to go down. Remember, a couple of decades ago, people said the same thing about CS, right? Not even just CS. There are so many companies that were so big that nobody thought they were going anywhere. But we don't find them anymore. Why? Things happen, right? That is why it's so good. But what it is the fund, they have criteria you have to be in that fund. So if one company is going down, if they're not doing well and they don't get to that, automatically you're kicked out, bring somebody in. So if I have that fund, I do not have to worry about those things anymore. You see, that is why it's so good to do the fund, especially when you don't know more and you are just starting. Yes, that's why I said I won't go for, I know NVIDIA is very hard right now. I wouldn't go for that, but I would rather be in a fund. Yes, as compared, NVIDIA will get you more than the fund. Yes, but yes, the fund is also doing good. All these funds are doing good. All right. Before we do that, also, so the first fund, the three things I'm going to focus on the ETFs. The first ETFs I'm going to focus on is the S&P 500. The S&P 500. The S&P 500 is it's a group of the 500 largest companies in the stock market. The 500 largest company in the 500, we all know these largest 500 companies are driving America. So if you are in that fund, yeah, you're good. But what you need to understand is the fact that you've got into that fund or you've bought that doesn't mean automatically tomorrow, it's going to go up, or tomorrow, no, or next week or a month or a year. What you need to understand is investing is risky. When you invest in the stock market, it goes up, it goes down. We've seen this over and over again. We've had recession, we have bear market, we have bull market. It goes up and down. But what I can tell you about S&P 500 is for the past 100 years, it has been averaging about 10%. It doesn't mean every month it gives you, every year it gives you 10%. Rather, on average, it gives you 10%, right? So let's take the first part, the last 5 years, for instance. All these years were good except 2023, which was bear market. Bull means it's up, bear down. So it goes down more than 20 or down, then we are in bear market. So last year it went up, 2023 went down, but the rest was like, I think 20 was like 18, 22 and all that. So it went up. So on average, it gives you 10%. That means you're doing very fine, right? Yes. So rather than buying this individual stock that you will be managing it when you don't really know much about it, you buy the fund, and the fund manager or the thing will do it for you. So the S&P 500, I'll give you an example of the S&P 500. We have SPY and VOO. SPY and VOO is by Vanguard. The next thing about the management that you don't have to worry about managing the fund and managing the stock is the expense ratio. The expense ratio is very low. Expense ratio is the fee you have to pay for investing in the ETFs. And when you look at this, expense ratio for SPY is 0.09%, and VOO is 0.03%. Yeah, see, and they are the same. They are all based on the S&P 500. The difference is because of the expense ratio, and also sometimes the analysis they have for different companies are different, but it's all the same 500 companies that they all invest in. So when you buy these, it puts you in that. And remember, like I said, it doesn't mean you're going to get everything by tomorrow or the next day, but at the long run, it's 10%. So it's good. All right. The next thing that takes me to the next ETF. The next ETF I'm going to talk about is dividend funds. This is because of the cash flow. So because of the cash flow, if I buy dividend fund, I do not have to wait for my money for the fund to go up before I make profit. No, that fund is going to be carrying me a check either a month, every quarter, or every year, right? So let's say if I buy $100 today, I don't have to wait for investment to go up before I get a profit, start making me something. But when it comes to the stock exchange, it's every 3 months you get something, and it's like they put a deposit or a check in your account. It's not like you get so that is called a dividend, right? And examples of these companies are SHD and VYMI. Yes, these are companies. When you buy, you get dividend back, so you don't have to wait. But at the same time, too, it goes up also. So you get something from getting all that, right? So let's take for example, if Walmart, which they made a lot of money last year, have over whatever amount, let's say they make about 10 billion profit, they have three ways of spending that money. One, they can put money back into the company. These companies, most of the dividend companies, they are so grown, they don't have to put a lot in there. And the next thing is they can give it to their their shareholders, and if you're part of the shareholder, or if you own a piece of it, you get this money back. That is called a dividend. So it's good to be part of those companies that also give dividends. The first one that we were talking about is the SHD. It's a dividend paying fund created by Charles Schwab, and this is investing. They invest in dividend companies that pay fund, right? Pay dividend companies. Yeah. So that is the SHD. The VYMI are created by Vanguard, and this is dividend paying companies outside the United States. Sometimes people don't want to take all the risk in here. They want to get more outside too. So these are funds that you can get, and they have more. This is just two examples that I'm giving. And like I said again, if I'm brand new, instead of focusing on just individual stocks, I will invest in these funds because these funds are a group of companies. So if one of them is going down, like I said, they have criteria, they got to be in there. If they don't, they're going down, they don't fit in anymore, they kick them out and bring somebody in. And you don't have to worry about the management too. And the expense ratio is also cheap. So S&P 500, which is the first ETFs, and the second one is dividend paying companies. That leads me to number three. The three things I'm going to focus on. The second one is the growth funds. These are, companies that are working to grow as big as possible and as fast as possible. So they are taking all profits and reinvesting into these companies back, right? Yes, almost of them. So these companies, they don't worry about paying you dividend at all. They just put everything back in the company because they want to grow, And most of these companies, this means if companies they're doing that, these are companies that are they have risk, but the profits, more potential returns, because growths are more risky for more potential returns. So it's risky because what it is, these companies, they are up and coming, they can just be gone. But again, if you're buying a fund of that, you don't have to worry too much because there are groups of companies that are come together and they are providing. If they don't fit, they kick them out. Example of these companies are fund KQQ. KQQ, I think we've all heard about Nasdaq, right? Yes, most popular. It is. It gives you exposure to that. The KQQ gives you exposure to that, which is a group of 100 largest companies in the stock market that they are not financial. And it tells you most of these companies are what? That alone tells you that these companies are more of tech. So yes, it goes up, the returns are very good, but it can easily go bankrupt too. But again, these are a group of companies. So if one company is not doing good and it's not fitting in there, they kick them out and bring one in. The next one is the VUG. VUG is created by Vanguard. It's a growth fund that invests in those types of, growth startup types of company. Like I said, we know a lot of these companies coming up. These are more of tech companies, and all these tech companies are, I would say, returns are good, but it can easily go bankrupt, right? So these are the three most ETFs I'll focus on if I'm just starting on beginning, right? So overall, we look at that the growth and fund stocks are more risky, more speculative for more potential returns, and the S&P 500 and the dividend funds, which are a little bit off on the safer side. The reason why I'm saying a little bit on the safer side is stocks or investing is risky. It doesn't matter what it is; it goes up and it comes down. So it's risky. So you can't bet on it. That's why it's so risky when somebody say, "Hey, I'm getting you a constant return of this amount." They specify that amount. That means you'll be paying too much for that. Yes. So these are these companies, these ETFs. So let me get you a bonus here for a few things here. Investing, like I said, investing is risky. And also doing all this doesn't mean one day or the next day, your returns just go up or your profit go up and all that. But the other areas that you can do, they call it a niche, right? Where your beliefs or where you think maybe this side or this particular um, side is going to go more, like this industry is going to go higher than this, or it's going to do this, then you can also invest in. So I'm going to get you a few ones. One of them is BOTZ. You see, BOTZ is an ETF that gives you exposure to AI and robotics. Yes, we all know AI is the thing now, and robotics, right? So if you believe that AI is going to be the next thing or the next biggest thing, then you can start investing. At this point, these companies probably these are very low. It's not that high. So you can buy this, but thinking or believing that it's going to go up. Yes, and these are also fun, right? ETFs, and these are fun. The next one is AGNG. This ETF that invest in companies that serve old people. You see, when you look at United States of America right now, you see that more people are aging, and very soon the retirees are going to hit more than 70 million. So you know where the money is going to go now. That means more money is going to be invested in that. So if you believe or if you know this is going to be a thing, you can start investing in. Like I said, this is not just 1 day or 2 day. You give yourself time. So the next 10 years, the thing that you invested in, like you bought it for maybe $10, is now 200. Look at the difference. That is why it's always imperative when you invest in. You just don't think of the short term, but long term horizon. The next one is IYG. This is an ETF that gives exposure to financial services, and we all know these are going to be something that is, the way finance is going. And I know it's going to be the next big thing is also finance. So if you believe in those things, you can go ahead and invest in those things. Like I said, and this is not something that you can just do it like a day or two. You see, the way to win is to follow a strategy. Many people call DCA. Some people call it ABB. That is when you always keep on buying, right? Because you don't have it just for a day. You have it for a long-term thing, right? So always keep on. So you set a cadence whereby it has to be consistent, passive, and automatic. If you want to do a long-term investing, these are the 3 things, and this is very tough. You have to be very disciplined to be able to do that. It has to be consistent. So you have to be 10 years time, or set yourself like the next 15 years. This is my goal, and I'm going to be investing $20 every week or $20 every month for the next 15 years. So it has to be consistent, and it has to be passive, and it has to be automatic. You don't have to be struggling to be paying all the time. It's automatic. It comes. The time comes, they take it out completely. So these are the things you have to make sure you do to make sure, you'll be disciplined to do that. Yeah, so set up those things, like I said, DCA, dollar cost averaging, and some people call it ABB, always be buying. It doesn't matter what it is. Because if you have a long-term horizon, hey, the next 15 years, this is where I want to be, this is what I'm doing. You don't care if there's recession going on, like what is going on right now with this tariff and all that. You don't care. You just keep on with your strategy and keep on doing it. As a matter of fact, I would say the only time you change your strategy is the only time when the stock is going down. Why? Because it's on sale. You see, the stock market is the only place where, or only store, when it goes down, we all run away, right? But when we want to buy a shirt, we go to Macy's, we go to whatever, and it's on sale, we rush to go get them. But the stock market, we just run away. Why? Because I don't know. I don't know why we do that, but that's what we do. So we have to be consistent, passive, automatic, CPA. That's what people call it. So, like I said, if you believe in a different industry, and if they have different ones. I just gave you just a little bit of example of this. Then you have to make sure you put your money where it is. So yet the stock, if you're brand new, these are the three things, and the other niche if you want to. But I would say you focus, if you're brand new, just focus on the three things: the S&P 500, the dividend, and the growth. And these are not individual stocks; these are funds. Fund, and it's going to get you to where you're going. If you do the consistent thing, it's going to get you there. Let me talk a little bit about paradigm shift. Paradigm shift is a program that we do every Wednesday to we talk to a lot of people that have get different ideas about other than the one that we have that didn't help us. And there are so many people that have the same ideas, they can't even do anything about it. But paradigm shift, we talk to them. So subscribe to the Patrick Breaffy YouTube channel to be able to get live show of it. And also, if you get in, we have talked to so many people. You can also, check out those videos. Patrick Breaffy, make sure you spend wisely, save intentionally, and be generous. See you. Bye-bye.